So the opening range that I use, a lot of people use different opening ranges to get that out of the way. Some people like to use, on the floor, they use like 1-2 minute opening ranges, very smaller time frames. Sometimes they'll use 5. I like to use a 10-minute opening range, and on different markets they have different ranges. So for example, on crude oil, it's the first half hour. For the S&P, it's the first 10 minutes. So in order to establish a bias, it needs to be half of that opening range, so it's 5 minutes. So if we see the 10-minute chart or bullish bias expansion example, you can see the first 10 minutes is highlighted. That's the open. And these are the pivots. You can see the overnight got through the pivots. The cash market squeezes off the pivots. These are the volatility windows, the solid lines. Gets through the upper volatility window. There's a little bit of a reaction down, but it gets through, holds above to establish a bullish bias. This lures in longs. Now for them to get paid, they need to defend that volatility window. That level becomes the first level of support. If that fails, it's back down to the open, and the reversal is just below the open. So in order to reverse that bias, they would have to lose the opening low. So as long as the market holds above its upper volatility window, it gives you the idea that the pressure is to the upside, and the buyers have the upper hand, and they can try to squeeze it and expand it into the close. So if you're trying to fade that, just think you're getting in front of the freight train. So it gives you, the vol windows give you a story for the day or an idea of what the flow is. If you get, again, a bullish bias that it's above a window and it holds above that window, then the pressure is to the upside. If this window is lost, then there's room to test the open, which is where the buyers would want to defend to try to prevent this from turning into a reversal. So another example of a bullish bias expansion, you can see the open gets a chop, falls down into the pivot, which catches the move through the opening high, into the upper volatility window, a little bit of a pullback, and then through, establishes a bullish bias. They can't get it to expand right away, get a little bit of a pullback below that vol window, and then this is the test of the open. So that vol window turns into a little bit of a resistance, but they're defending the open, and as long as those buyers defend that open, they're in control. The bias for the day is bullish. They recover the upper volatility window. It gives them room to run into the close because the sellers could not break it lower. The sellers are on the hook. The buyers control the day. They defended the open. So again, when the bias is established, I don't necessarily get long right away. I look at, it gives me the idea to buy pullbacks. And if I'm looking to be a contrarian, then I'll look at the bias to be established and the market to pull below the volatility window. So those buyers get trapped and I'll sell the retest.